Hey, listen, hello everyone. Thank you so much for giving me your time. I just have to scroll the slides down to and here we go. And I'm from rightlinetrading.com. Our email address is info@rightlinetrading.com. Here's our phone number. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years, and I began trading futures, forex markets, stock markets, actually more than 10 years ago, around 1996, 97. And what I did my graduate work in was the optimization of closed systems. And back then what I did was optimize underwater decompression schedules for the US Navy. And back when I was in college, there were only a few computers in the whole world, and they ran on punch cards. So the optimization of any closed system was really a major endeavor. But when I really focused on the financial markets, what I saw was that each financial market is essentially a closed system, and it's controlled by different forces, which we consider to be independent variables. And if those independent variables can be determined and they can be placed in a multivariable equation, and that multivariable equation optimized, then you can predict the future direction of price on any financial market. I mean, the problem with day trading and swing trading today is that there's not enough scientific rigor brought to the way that we day trade into technical analysis. And what I'm going to do today is show you an indicator which really has tremendous predictive power in determining where the future direction of price is going to move. Now, this really is the indicator. It's called the three-line indicator. Now, the first line does a multi-time frame assessment of momentum, and momentum is assessed via a MACD system. Now, I'm going to talk more about it later as we go through each individual line and how the three line creates its colors and exactly what it's assessing and what makes it a leading indicator. The second line is stochastic, and the third line is order flow. All three are equally as powerful and important in determining where price is going to move out into the future. Now, if the line is red, it means that you have an alignment of momentum, stochastic, or order flow. If it's green, it's aligned to the upside, red aligned to the downside, and yellow means there's no alignment. Now, let me just say one other thing. This momentum assessment, stochastic assessment, and order flow assessment is not done off of your trading chart. It's done off of the two higher time frames. So if you trade, say, a 3-minute chart, it's going to look at momentum, stochastic, and order flow on the 9-minute and on the 27-minute. If any indicator uses data from your trading chart, it doesn't have the ability to look out into the future. The price on your trading chart is in general going to move out into the direction of the two higher time frames. And when those two higher time frames align, that's when you've got a potential nice setup to trade. So what you want to have is momentum. If you're trading a 3-minute, align on the 9 and the 27. So let's say you're trading an 8 range. It's going to look at the two higher fib numbers. It's going to look at the 13 range and the 21 range. If you're trading a tick chart, let's say you're trading a 377 tick, it's going to look at your 610 tick, and it's going to look at the next higher fib number. So none of the information that's coded into this indicator comes from price movement or any data from your trading chart. It only comes from the two higher time frames. Now let's first take a look at order flow. Now, order flow tracking is very, very important and very powerful, but you're going to see how it can fool you if it's not smoothed and it's not accurately assessed. Now, if you look right here at these candles, each of these candles has a delta. And the delta tells you the imbalance between the number of aggressive buyers and the number of aggressive sellers. Now, in general, a negative delta on a candle predicts that the candle's going to close to the downside. But that isn't always true. You can see there's a positive delta here, yet the candle closes down. And this is a negative delta, yet this candle closes up. So if you simply take these numbers from your trading chart, which is what 99% of all these order flow tracking systems do, and you put the delta, just track it down here, you really don't have any predictive power, since a negative delta can be seen in an up candle and a positive delta can be seen in a down candle. So what we do is we don't look at any data from your trading chart. We only look at the data from the 2 higher time frames. And we take these delta numbers, and you can see no individual number has significant predictive ability. So what we do is we put it into a 15-period moving average and get a delta moving average. And that delta moving average off of the 2 higher time frames has huge predictive power. So that when you get an outlier, like this negative delta on a positive candle, it's filtered out because it's in a 15 period. So it looks at 15 candles, and you can see that there's got a huge positive here, a small negative, a huge positive, a huge positive. Here's a small positive, a huge positive. Here's a big negative. So by putting it into a 15 period, it smooths that delta and gives it real predictive power and telling you who's in control of the market, buyers or sellers. Now, if you look right here, this is the E-mini, and this is also true on stocks, and it's also true on the Forex. And here is the 3rd line of the 3 line, the order flow line. Now, I set these to 0 to kind of drill down the fact that this order flow tracking is not looking at the delta of your trading chart. Here, it's looking at the 8 range and the 13 range, and it's looking at the delta moving average of those 2 higher time frames. Now, when the delta moving average is aligned to the upside, you have to trade in the long direction. If you don't, you're very likely going to get stopped out. When the delta moving average is aligned to the downside on your 2 higher time frames, you're almost always going to get price follow on your trading chart, and you can only trade short. The same thing here. You can only trade long. It's giving you an absolute directional bias. Here's another example. Now, this is an area off a market profile that creates resistance. Now, you know, with order flow aligned to the upside, or order flow tracking, telling you there's a preponderance of aggressive buyers in the market, with the delta moving average moving up on the 2 higher time frames, you can only trade long. So as soon as you break resistance, you're going to take a long trade. And that's going to give you what we consider to be a low risk, high potential reward trade. And what you need to do when you trade is you need to avoid risk. And this is the way to do it. Anytime I ask a trader what is the number one goal to achieve when you trade the market, they'll say, well, it's to get winners. But that is one of the reasons why so many traders are unsuccessful. It is not, your goal is not to get winners. It's to avoid losers. And to avoid losers, you have to take trades that have a minimal amount of risk. And to minimize risk, you must trade in the direction of order flow that is assessed on your 2 higher time frames. And you can see all the traders here trying to counter trend trade, and they're all going to get run over. And here's another example. This is really a live example of a trade taken in the trading room. It's just a move and a pullback into resistance and a continuation in the direction of order flow for 18 ticks. It's not assessing anything that's going on the 8 range. It's assessing the delta moving average of the 13 range and the 21 range. Now here's another example. Again, these are support and resistance areas that are created by market profile. As soon as you get support broken, you can only go short in the direction of order flow. As soon as you hit the support of the point of control, you're out. And then, based on the direction of order flow, you could take a long trade here off support. And then when you come back up to resistance, you can only go short. Gives you an absolute direction. Market profile provides you with areas of support and resistance with which to trade off of. And you can see all the traders in the counter trend direction to order flow here. They're going green. They're buying an up candle. They're going long, and they're all getting run over on the trade. So when you trade against this direction, you're very likely to get a loser. Here's just one more example. Here's resistance. You break it, you're sitting on top of support, and up you go in the direction of order flow. Again, multiple opportunities to trade. Price is sitting on support, long, comes back to support, long, back to support, long. And if you want to take a counter trend trade, you have to wait until order flow reverses. Counter trend trades are very risky, but you cannot even think of taking a counter trend until order flow reverses. Now you're going to take the trade out at support. You anticipate a bounce off support. You don't really get much of a bounce. It breaks support. And then you're going to have to wait for price to come back to resistance and take a short trade if order flow is in the down direction. Now, let's move to the MACD. Now, MACD is a good momentum indicator, except if you use the MACD on your trading chart, it's going to get you into some trades, but it's going to also buy you lots of losers. Now, first, you can see right here, I put this black line here to show you the MACD crossover. So this is where you would take a short trade. But you see you're trading right into support, and you go nowhere. And even though the MACD is crossed over, the signal line has crossed the MACD line, or to say the MACD line has crossed the signal line, and the MACD is telling you to go short here, price is going up. And it just happens way too commonly. So this really doesn't have much predictive power in determining the future direction of price on your trading chart. In addition, the divergence signal off of MACD is just notoriously poor. And if you trade it, you're going to get really burnt. You have divergence here. Price is making a higher high. The MACD is making a lower high. If you took the short, you get run over. Here you have price making equal highs. The MACD making a much lower high. If you shorted it, you're going to get run over because price makes a new all-time high. So you can see that the MACD system used on your trading chart doesn't have any predictive power in determining where price is going to move out into the future. There are lots of traders using it. That's why they're caught in these counter trend directions and they get run over. Now, MACD divergence, we've assessed it. It's real poor as a signal to take a counter trend trade. So what we do is we use the MACD off of the two higher time frames. And we assess it a little bit differently than you would assess it using the indicator. We don't wait for the MACD line to cross the signal line. What we do is we look at the slope of the signal line. As long as the slope of the signal line is down, the MACD is down on our 3 line. If the slope is up, then we assess the MACD is up because we're just looking at momentum and we don't give much weight to the crossover of the MACD line with the signal line. We're simply taking the data that a MACD does, we're simply reinterpreting it a little bit to give it more predictive power, and we're only using that off of the 2 higher time frames. Again, if you're trading a 2-minute, it's looking at a time frame that's 3 times slower, which will be a 6-minute, and then 3 times slower still, which will be an 18-minute. Or the 2 higher fibs from your trading chart if you're trading tick or you're trading range. So now we have momentum and we have order flow. We've added specificity to the indicator to provide it with more predictive power. Now, it may keep you out of some winning trades, but it's going to give you the ability to avoid a ton of losers. And that's our goal. Our goal is not to get into every winner. If that's your goal as a trader, whether you're a day trader or a swing trader, you're not going to make money. Your goal is to avoid as many losers as possible. And then when you take a trade, you take it with as little risk as possible. And that's what really does make you a consistently profitable trader. Now, these two forces are both independent, so they must be aligned. They must be aligned in the same direction. And you can see once you break resistance to the upside, you run. Here's the E-mini. Now, I took the time frame off and I took the instrument off because this is time frame independent and instrument independent. This could be a stock, this could be a Forex pair, and this could be a future. When order flow and momentum are aligned to the upside, you can only take a trade long. And if you try to counter trend trade these two forces, you're going to get stopped out repeatedly. You want to take a pullback to support and go long. Pull back to support and go long. That's the key. Now, I do want to mention these two indicators. And I know I have till 2:30, and I don't want to run over because these indicators come with the package. This is simply a 50-period simple moving average. It's not a complex indicator. It's simply coded when the slope degree becomes significant enough, it turns green. When it's flat, it's yellow, and when it's sloping down, it's red. So it gives you an assessment of momentum on your trading chart. And that's real important. You want to take a long trade when the 50 is either yellow or green. Momentum is with you. Now, this is a real complex indicator. It's really one of the cleverest we have, because it's an amalgam of a 15 period and an ADR-ADX indicator. And an ADR-ADX indicator is a way of measuring volatility. And you only want to trade when the markets are volatile. So when you have a lot of volatility and the 15 period is moving up, the likelihood of getting a winning trade is very high. When the 50 and 15 are green and order flow and momentum are aligned to the upside, you've got a very low risk, high win scenario. When volatility falls and the 15 period flattens, that's where the chances for getting a winning trade drop and risk gets higher. Now, I wanted to show you what happens when these two forces don't align. And if you ever wondered why the market chops, I'm going to show you why. When you have momentum aligned to the downside and order flow aligned to the upside, price doesn't have any idea where to go. So what does it do? It simply chops. And if you take a trade, when these two forces don't align, you're likely to get stopped out. What you'll want to do is wait for them to come into alignment, wait for the 50 to go red and the 15 to go red. You wait for that 50 to cross the 15, and then you've got yourself a great short trade. All you need is a pullback to resistance and an entry short. And you have a very, very low risk, high potential reward trade. Again, no alignment here. Market chops. It aligns and up it goes. Now, the stochastic, we've also modified its interpretation to give it more predictive power. When the market's overbought or oversold on the two higher time frames, the stochastic line will always be green, overbought, or red, oversold. In addition, stochastic divergence fails a lot. And here's equal highs, and here's stochastic divergence showing a lower high. It's actually the same chart I showed you before for MACD divergence. Both MACD divergence and stochastic divergence fail. But stochastic divergence has a little more predictive power. So the 3 line is going to show you divergence. But what I'm going to recommend is that you most oftentimes ignore it. But we wanted to code it in to give you a heads up and let you know that you were getting a divergence signal. And remember, the divergence is coming off of the stochastic, off of one of your higher time frames. So it has a little more power in predicting a potential market turn. So when the market's overbought, that middle line, the oscillator line, stays green. When the market's oversold, the oscillator line stays red. Now, in between, it's just a question of where the signal line and the oscillator line are. If the signal line's below the oscillator, if the oscillator line's below the signal line, it's red. If the oscillator line is above the signal line, it's green, just like you would interpret the oscillator all the time. Then in a strong uptrend or strong downtrend, potential divergence will trigger a color change in the oscillator line. And I'm going to show you an example of that. Or here's an example. You see the middle line here, which is the oscillator line. The market's in a strong uptrend, and all of a sudden that middle line goes red. So you have to decide whether you think that divergent signal is going to trigger a reversal in price. Now, this is coming off one of the higher time frames, so it has a little more predictive power. And I'll tell you what I do, I always ignore it. Because it's only one of the two higher time frames giving you this divergent signal. And you're in a strong uptrend, and you also have momentum and order flow continuing to align to the upside. This is one of the reasons why the divergence signal fails. Now, I wanted to point out one other thing, now that we have the whole three line here, and that is to make it easier to interpret. When the three line is aligned to the upside, the candles will have a halo around them that it's a default color. I color them sky blue, and you can see that the candles are telling you that the three line here is aligned to the upside. When the candle's black, there's no alignment. And when the candle is this orange color, and you can change this color, it's aligned to the downside. So you don't really have to pay attention to the three line. All you have to do is pay attention to price. So when price comes back to the support, you go up long. Comes back to support, you go long. When you have a yellow modified 15, you stand down. Comes back to support, you go long. Back to support, you go long. These are very low risk, high reward trades. Same thing here. The candle outline tells you the direction of the three line. Now the candle halo will appear even if the momentum line is yellow, because what we did, this is telling you that the MACD line is heading in the appropriate direction, but the crossover hasn't occurred yet. So the data is all transferred to the candles. So if order flow is green, stochastic is green, and momentum is yellow or green, you've got your long. If order flow is red, stochastic is red, and stochastic is yellow or red, you have your short. And you just follow the candle color. You get a pullback to a green and a green, you go long. Pullback, you go long. And these are very, very low risk, high reward trades. Your higher time frames are calling this signal. Same thing again. Support, long, support, long, support, long. And what I did here, I just put in arrows. And here, I just changed the default color that shows you the candle outline. So all you have to do is pay attention to the price. And you can see that all the traders who are counter trend trading in these orange or red candles are all going to get stopped out if they trade against the three line indicator. If you're wondering why you're not making money and why you're potentially caught in the counter trend direction, this is going to show it to you, and you will never do it again. Now, this is just a trade I took in the trading room. This is for 2.5 points, and this is the whole system. And you can see that the three line is right here in the middle. All three are green. Candle is outlined. It's trading right off of the value area high, and it goes up for 2.5 points. Now, I want to quickly, so I don't run over, show you the chart. Now, this is an actual chart of crude oil. Crude wasn't so great today, but here's your short trade right here. Now, it shows you an absolute direction. Now, if you took your short trade here, you would not have gotten stopped out. But you've got your move down, your retracement back to resistance, and the continuation. the move down, retracement back to resistance, and down. Now, he was a great trade. It occurred really early in the morning, right here. I just want to take the trades here's your great long trade right here. The break, pull back to support, and up. 50 and the 15 are green. 3 line is with you, calls the trade. You're going to very rarely see a loser like this. Now, I want to quickly change to the E-mini because I can change to any instrument I want. And let's just change this to a 5 range. So that's what we trade. And I'll show you the E-mini. And later, when I look at questions in the room, I will. Look at that short trade right here. This short trade right here. They're unbelievably low risk, high reward trades. Right here. Right here. And you can see these traders in these green counter trend candles, and they're just getting completely beat up. Now, if you trade this with 3 or 4 contracts, this is a $600 or $700 move on this entry, and this entry. I'm not going to scale it to find the exact number of ticks it went, but these are very lucrative moves. And here you have the same thing to the upside, right here. Now you go long here, probably wouldn't get anywhere, but it's simply going to come back here. And depending what your automatic trade management strategy is, maybe it's going to take you out. You're going to re-enter here. You have the 3 line with you here, here, and here. All these counter trend traders are getting beat up. On this move up, you don't have the 3 line. So there's no trade here. Now, I took this trade this morning. Right here. This is a very, very big move. It was 3 1/4 points. I actually took this one too, which is a little bit riskier. I took both these trades. Now, I stood aside on this trade because the market was somewhat oversold, and this candle didn't come back as close to resistance as I would have liked, but there was another winner. And you have the same setup here for a short, the same setup here for a short. And here are your long trades. You don't have the 3 line here. Even though the market went up, you just don't take it. Here's your trade right here. And then here are your killers at market open. Here, you probably won't get a target. And then here, up you go for a really nice move. And it trades this way on any financial instrument that you want. Does not matter what it is. And here's, this is, I call this where the market goes right around the corner. It breaks and retests the 15 really quick. And even though the 15 is yellow, because it swings around so fast and the 3 lines in your direction, you got that great move. And it's going to keep you out of losers. When you don't have the 3 line with you, you're simply not going to take the trade. And it's really going to prevent you right here, this continuation, loser. This potential continuation short, loser. This potential continuation, a gigantic winner, because you have the 3 line with you. Now there's a potential continuation. You don't have the 3 line and it works, but that's okay. So it just has tremendous predictive power. And I can show you this on instrument after instrument. I don't want to run over and I want to have time for questions. So what I want to do is I just want to show you our offer, and then if you want to see this on other instruments, I don't have my Forex data feed, so I can't show you it on Forex. I can show it to you on any future you like. I could actually show it to you on Yahoo if you want to see it on stocks. But let me just go to our offer. And no matter what your trading methodology, it's going to help you out tremendously. And let me show you exactly what you get. Now, there's a lot of traders in the room. So for the first 10 orders, you're going to get the 3 line. And it's called our 3 line V2 because it's gone through 2 revisions. And the offer is $399 for the indicator. But for the first 10, you also get a month in the live trading room with me, and I trade with Chart Trader Up. I trade the E-mini and crude. I take all the trades I call well before they hit. Everyone has an opportunity to get in them, and you're going to learn our trading methodology. You also get a 10 module weekly educational training session. So you'll learn the way we trade from the ground up. And you get a great idea from being in the room, seeing the trades I call, and you'll watch how the 3 line helps me call all the trades. And then what we're including here also as an additional bonus for the first 10 is you get the 50 period and you get the 15 period. Now the 50 period is just an SMA colored. We give you a default slope degree, and that slope degree is very helpful. But that 15 is really, really a remarkable indicator because it not only indicates support and resistance on a 15 period basis, it also gives you the ability to assess volatility, and you want to trade the market when it's in its volatile period, not when it's flat and there's lack of volatility. So this is really a trading system as well as an indicator. Plus, we give you a huge amount of educational support. Now, if you have a different trading methodology, it won't matter because you want to trade in the direction of the multi-time frame assessment of order flow and momentum and stochastic. If you don't, I can promise you're going to be trading in the wrong direction and you're going to get a lot of trades that stop out. Now, here's our web address, here's our email address, and here's our phone number. And let me see if there are any questions. I've got 5 minutes. If you want to see the system on a different market, I can't do Forex because I can't hook up another data feed. I can put a couple of stocks in, and I can't put any futures market in. So hang on, let me take a look at questions. Okay. Okay, no problem here. Let me clear this. Let me show you the Russell. Here's the Russell. Just going to take it back to the beginning of the session. Your entry here, your entry here, no entry here. This is just all chop. Now this pullback did not have the order flow line. So it worked, but it just wasn't a setup for us. And neither did this. Now here's your great long trade right here. Well, the Russell's tough to trade because there's just not a lot of volume. And let me show you the NQ. The NQ is brutal. We have to go to a 13 range. Okay, I can already see we've got really good setups here. Now to avoid chop on the avoid taking chop on the 13 on the NASDAQ, which is a real choppy market and really flies, you must trade with the 3 line. You can see the great trades you got on the NASDAQ. Here's one. Here's two. That's a little riskier because I don't like to take a trade, on a hammer, which go along here. Now on the yellow modified 15, stand down. You have nothing here. You could take this trade long. Remember, you want the 15 and the 50 to be the same color right here. Long, 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 long. There's a great trade on the NQ there. There's a winner there. And there's a winner there. So, I mean, there's just today you could have killed the NQ. You want to see ZB? Sure. Sam, hang on one second. Let me do that really quickly. I have to put ZB into my control panel. I don't normally trade it, but I'll stick it in real quickly. We have an auto trader that trades ZB, but let me stick it in. Okay, it's there. Now let me move to ZB. No, I don't know why we're not getting. Let me go to a 5 range. No, we're not getting that much data. Hold on a second. Let me go to the days to load. I only have 1 day to load here. Let me put in 5. Let's load the data. Okay, here we go. Okay, I can already see some good trades. You can see them right here. Just right here, long. Right here, long. 50's green, 15's green. 3 lines in your favor. We don't count the trend trade. Now here's your short. That one's a little risky. This one's extremely safe. This one's extremely safe. So we've got 1, 2, 3, 4, 5 winners. So 5 winners. Let's go back a little bit further. This one doesn't have the 3 line. This one does not have the 3 line. We can go back a few more days. Let's go back 10. And then we'll finish with that. So because it's just 2:30. I'll take 30 seconds to do this, and that'll be it. Here's one. Here. It's not a huge winner, but it's a winner. Can't get this move. Can't get that short move. can get that one. It's a little riskier on a yellow modified 15. Now, this is not turning for you. Well, this is a trade because you're on stochastic divergence. And remember I said you would ignore it? I would ignore it. So this is an entry. Here, you have a long period of stochastic red. You have no entry here. I'm not going to give you an entry, but I don't think it would work. That's an entry. This is not an entry. And then we have all the trades that I just showed you. Here, here, here. So you got great entries. You're not going to get a million of them because there's not a lot of volatility on ZB. And actually, I'll just tell you, Sam, I trade bonds on a three range. I think a 5 range is a little bit slow, but you do get great entries on it. So listen, everyone, thank you so much for having me. I hope you'll come aboard. I hope you'll come into the trading room. We make money almost every day. But the 3 line along with the 50 and the 15 is a real reliable way of taking a trade. If your 50 and 15 are not green and the 3 line isn't with you, the probability of getting a loser is high. If they're with you, it's a very low risk, high reward trade. So listen, everyone, have a really, really great day. Here's our number. I'll just scroll through it really quick right here, 786-713-5276. I don't want to hold up anyone. Listen, again, thank you so much for having me and for listening to my webinar. Have a great afternoon. Bye-bye all.